In this segment, we will look at what inventory items are reported as an asset for a company. When we are looking at the accounting for inventory, there are three primary issues that we need to look at. The first is determining what is included in the inventory cost upon purchase. The second will be how to determine the inventory cost, or how to track inventory cost as inventory is sold. This helps us determine the cost of goods sold to record, as well as what ending inventory is reported on the balance sheet. And finally, the third issue is applying a generally accepted accounting principle rule called the lower of cost or market. In this segment, we're going to look at this first item, determining what to include in the inventory cost upon purchase. All inventory that a company owns should be included as an asset in the merchandise inventory account, regardless of where the inventory is physically located. So if there is inventory in transit, in other words, if a company owns inventory while it is in transit, it is recorded as part of the company's inventory. If a company has inventory on consignment, consignment means the inventory is owned by the company, but it is on display for sale at another location. The company still owns that inventory, even though it's not physically in their possession. So the inventory is still included as part of their inventory. And finally, inventory that is damaged or obsolete. If a company has inventory that is damaged or obsolete, in other words, it's not sellable, the cost of the inventory needs to be reduced to the amount that it can be sold for, which is what we call the net realizable value. When we purchase inventory, we are going to record the inventory purchase cost. That includes all costs incurred to purchase and get that inventory ready for sale. So we will start with the original purchase price of the inventory. We will subtract out any purchase discounts or allowances that we take on that purchase, because we're not really truly paying the inventory purchase price due to taking a discount or receiving an allowance. So the amount needs to be subtracted from the original purchase price. We will then add in any additional cost incurred to get that inventory in place and ready for its sale. That will include freight or shipping costs, any taxes we pay on the purchase, any storage costs we incur, plus any insurance costs. So the total inventory cost that we record upon purchase is the original purchase price, less any discounts, plus freight or shipping, plus taxes, plus storage, and plus insurance costs.